The market is crazy volatile and Alibaba reached record multi-year low in the last few days. They just reported earnings and I will tell you right away what they liked and didn't like about that. On the positive, the international growth story is still intact and they are executing on that. Yes, revenue growth came in lower than what we have been used to, at 10% year over year, but the entire industry and China is seeing this slowdown, so it's not just Alibaba. If we jump into the latest report numbers, you can see that China commerce dragged down growth because it grew only at 7% year over year. Whereas the international e-commerce sector grew much faster at 18% year over year. This is expected. They have already won in China where they reached 979 million consumers. This is the cash cow of Alibaba and it will generate money for years to come. But it's not where new growth is, which is instead will be found in the international segment and other initiatives. For the other initiative, we can see that the local consumer services grew at 27%. Kainao, which is the logistics service, grew at 15%, cloud at 20%, digital media and entertainment stood still at 0% growth, and innovation initiative and others grew at 63%. When you look at the weight of each sector in this column, you can see that total China commerce is 71% of their revenues, whereas the other sector counted only for single digits. This is why, although we see a very high growth in the overall number, we see only a 10% growth. I think this was totally expected. We know that Alibaba has more or less capped on the Chinese market, so growth there will come mainly from increasing average revenue per user, and it will be slower than what we have used to. However, I think that it is encouraging to see solid growth numbers for the international commerce and other sectors, because it means that the investments that Alibaba is making here are materializing in higher revenues, and all these sectors are very far from getting saturated. And this also means that if this growth trend continues, we will have these areas become a more and more important part of the revenue pie in the not so distant future. What was really bad was margins. We should also not be surprised about this. In the video I made last month, I did warn about margins coming down for Alibaba, and we are seeing this happening now. What margin is the percentage of revenue that the company keeps for itself as profits. If we look at the financial numbers, we can see that the total cost and expenses increased 19% year over year. However, if we look deeper at this, we can see where this increase came from, and we can see that half of it, or the 10% of the increase, came from impairment in goodwill. This is a one-time paper loss in their digital media and entertainment assets. I'm not worried about this, it is just an accounting mumbo-jumbo. Then, 6% of the extra cost came from increased cost of sales. If you dig into the reason for this, is due to the higher proportion of the direct sales business, such as supermarkets, which have a higher inventory costs as a percentage of revenue, as well as growth of Taokaiya business, which as well has lower margins. I'm not worried about this because we knew very well this would happen, and it is a toll to pay to have a more diversified revenue stream, which I think is a good idea. Then, the remaining 4% of the 19% came from an increase in sales and marketing expenses. The increase was primarily due to an increase in marketing and promotional spending for user acquisition and engagement on the mobile commerce apps. This I'm less happy about because it means that Alibaba needs to subsidize at a net loss the acquisition of these new customers. However, if these new customers will bring in the long-term profits, it is a great investment for the long term, for which I'm all up for. So bottom line is that the 19% in increased expenses is worrisome, but when you look at it deeply, it's not that surprising and may be temporary and lead to fuel growth going forward. When we go and look at profits as adjusted EBITDA, then that's where the pain is. Earnings plunged from 61 billion renminbi to 44 billion renminbi from the same quarter last year. As seen as percentage of revenue, that is a drop from 28% of revenue to only 18% of revenue. That's a gigantic drop. It is because the non-China commerce part of the business is getting bigger and bigger, and it is also the unprofitable part, as you can see in the margins here that are negative. So all this was expected, but is not great to see. I think these exercises in going through this number are really important because this is what allows us to understand what is going on with the business and understand it at a fundamental level. Let's move into valuing the business, but before we put numbers in the valuation, I just wanted to show you the free cash flow development over the years in this row. It increased strongly up to 2021, and in the past trailing 12 months, it dropped to levels similar to 2020. And this means that if we look at free cash flow margins, they crashed to 15.8% this year, which is significantly lower than the around 30% that they printed in the previous 3 years. Again, this is due to the investments in new markets and diversification. I don't think this is getting better though, and I do believe in the pessimistic outlook that it will stay at these low levels of 15% for several years, as long as Alibaba completes this investment cycle. So if we move at the predictions, we have 2022 and 2023 revenue predictions in red here, which means that analysts are predicting a 24% and a 16% jump in revenue from the previous year. I decided to take the more pessimistic route and I slowed revenue growth massively, all the way down to 5% in 2030. This basically reflects if what they are doing doesn't work out and the revenue growth keeps decreasing and is not compensated by high growth sectors like cloud and the international e-commerce business. But I want to be conservative because there is a chance that it will not work out the way they want, and I want to be conservative with my estimations. Okay, let's move to free cash flow margins. I expect that they will keep on spending like crazy, and I estimate for the 5 years that margins will stay at a low of 15%, for then gradually come back to 20% as the sectors mature. But still, I estimate lower margins than the 30+% of the past because I do believe that they will never be able to match the margin they had when they dealt exclusively with Chinese e-commerce. Multiplying the margins with the revenues gives us the predicted free cash flow that you see here in this row. If we visualize these predicted free cash flows in the graph in blue, it means that it will take up to 2025 to reach the free cash flow values we had in 2021. Okay, let's paste the predicted free cash flow values in the discounted cash flow valuation model in this row. We have the discounted values in the row below. The discounted factors, we set it to 6.1%, which is the weighted average cost of capital of Alibaba. If you are interested in seeing how I calculated it, you can stop the video here. Over here, we calculate the terminal value of the business with two models, the terminal multiple and the perpetual growth model. And then we took the average of the two in here. For the terminal multiple, I looked at the price to free cash flow valuation of Alibaba from all the way back from 2015. You can see that for most of Alibaba history, investors have valued the business in the 20 to 30 multiples, and that in the past few years, as sentiment turned negative, the multiples have reached ridiculously low levels, below 10, which is extremely low for this type of business. I do expect that the very negative sentiment around Chinese stocks will eventually fade away, and the multiples will come back to a more normalized levels. Therefore, I chose to assign a terminal price to free cash flow multiple of 17. For the perpetual growth model, I chose 2% as the perpetual growth rate. In this cell, we have summed up the future free cash flow values with the average terminal value. Here we corrected for current assets and total liabilities, and dividing that by the share outstanding, it gives us a fair value of the business of $378 per share. Given that Alibaba trades as little above $100 as I'm making this video, it means that Alibaba is immensely undervalued based on my calculation, and that the stock should almost quadruple to reach its intrinsic value. In conclusion, I don't think there was anything shocking in this earning report. The non-Chinese commerce is becoming a bigger and bigger part of the revenue, and we knew that was coming. And the good is that it will fuel growth for the long term, but on the other hand, it will compress profits in the short term, which we also already knew. So the sentiment is bad, and I do expect a continuing of short-term catastrophic headlines. But when we look at it at the business from a quantitative perspective, it's just so cheap that an avalanche of bad news are priced in already in the stock. So this is one of those investments where the business downside is limited and the upside is enormous. To reach my calculated intrinsic value, the stock should more than triple from this point. Full disclaimer, I own the stock. I love the valuation, and although there could be more bad sentiment in the next few quarters as the company turns into the international expansion, at some point the stock will catch up with the fundamentals, in my opinion. I think this is one of the best risk to reward plays that I've ever seen. That's it for today. Let me know in the comments what you think of Baba as an investment. And see you in the next video. Before we go, I must remind you that I'm not a financial advisor and this content is not financial advice. It's just my opinion and you should do your own due diligence before investing in any product. Have a great day.